Alternative finance really has sprung out about because of that rigid way of actually the banks operate. So really what you're looking at is a lot of companies have come up with different ways of doing finance by using different mechanisms to assist them to provide that finance. So what we're looking at here is more of a strategically minded way of offering finance. It's more needs based than solution based. And also, it's a much more face-to-face service. Even a lot of the technology ones, the fintechs, tend to have a face-to-face service to them. And technology is really a big enhancement in order to deliver that kind of finance. So really what I'm going to talk about is two alternatives here. One which is called cash flow finance. And what that really means is driving payment quicker into your business. I mean, we all know through the press, there's a lot of pain points around businesses getting paid on time. And then after that, I'm going to tell you a little bit about purchase payables finance. In other words, finance that's really dedicated to helping you to be able to either have better terms with suppliers or pay suppliers, but alleviate that strain on the working capital within your business. So cash flow finance, it's all about speeding up getting paid. So, as you might raise an invoice to a customer who's on 30, 60, 90 days, actually getting that cash earlier is really a big benefit to a business. And we all know smaller businesses, one of the biggest pain points is cash flow. So really what alternative finance solutions have provided is a cash flow solution against an invoice. So you raise an invoice to a customer. That invoice, as I said, could have 30, 60-day terms, but the financer pays you typically the invoice or a large percentage of that invoice immediately. So you get cash. The invoice typically acts as security, and other securities, there are insurances typically used in order to protect the financer as well. So these sort of solutions can be really flexible because if you've got some invoices that you feel a little bit more concerned about the terms on, you can just factor those invoices. Or if you're looking at a particular client, you could do that. But equally, if you're looking to grow your business and bring on more customers, and one of the concerns is I can't trade with more clients without taking a loan, or example, an alternative would be to use a product like cash flow finance. You bring on new clients, you actually use the finance to get paid early. You don't have the cash flow constraints that those new clients might put on your business. So it's a great product for using on your accounts payable solution. Now, so accounts receivable. Your payable solution, that's the other side where you're looking at actually paying your suppliers. Now, if you're buying raw material or goods from suppliers, and then you're then on selling them, you might be housing those goods, or you might be using them as a component within something that you then make and sell on. And of course, it can put a lot of pressure on your cash flow because you've had to pay your supplier. And now you've got to wait before you can even potentially sell those goods on to your customer. And as I've said, on the cash flow side, you might then have to wait 30, 60 days to be paid by the customer. So payables finance has sprung up to allow a business to effectively finance the invoice to the supplier. So as your supplier raises an invoice for delivering goods to you, you can use the finance to pay that invoice and then pay the financer later. So of course, it means you can buy all the goods, all the materials you need for your business. You can do so without the stress of needing the working capital to do it. And what you can also then do is have enough time to actually turn those products into sales and then on sell them to your customer. So if you think of it as your accounts payable and accounts receivable, on your receivable side, you've got the cash flow. On your payable side, you've got the payables finance. And as a business owner, having the two gives you the ability to pick and choose where you would have a working capital constraint or a cash flow constraint within your business. Again, a little bit like the cash flow side, this product typically will have an insurance back to it as well. It's invoice led. You pick and choose the invoices, and there's a lot of flexibility in alternative finance. So again, you could pick potential supplier. You might go to a supplier, for instance, if you're buying on 30 days and offer them COD for a discount. We know a lot of suppliers will offer a discount for early payment, and that discount alone can be far more than the cost of the finance. So in effect, the cost of the finance can be free to you. And the guys here today will obviously be able to take anybody through this and explain to you how this could potentially work within your business and how you could start to deploy these sort of finance solutions within your business. They can sit alongside your normal run-of-the-mill funding from a bank, and what they do is give you the ability to control your business from as I said, a working capital and cash flow finance perspective. So I suppose the question is, what kind of businesses can qualify for this sort of finance? And again, the alternative market has really looked at trying to deliver these products for, one and all businesses. So wherever you sit within the supply chain, you should be able to access these products. They shouldn't be held back for the guys at the top of the supply chain. And I think alternative finance has spent a lot of time, or finances have spent a lot of time taking the corporate solutions and bringing them down into the SME sector. Certainly with the payable side, you'll see that a lot of these products would traditionally have been held back for the large kind of firms. So the kind of businesses that can qualify really are businesses that are growing with a trading history of typically 6 months, working normally within a business to business space for the cash flow finance. A funder will typically only finance the invoices if your customers are other businesses. But from the payable side, if you're working B2C as selling to domestic customers who are consumers, that's fine. Your suppliers will be businesses. And if you're importing or using local businesses as part of your supply chain, again, that's fine as well. Businesses, and we all know coming towards the end of this month, JobKeeper is ending, and there's a lot of businesses that have relied on government support to help them through COVID. One of the things with getting going without that finance is getting paid earlier is a critical piece. Cash flow finance can absolutely help there. And maybe buying stock is another problem, and the receivables finance can help there. And the beauty about this is, instead of going through a rigorous application process to get finance, what you're able to do is effectively get finance just for those invoices, either to help kickstart your business or to help you grow your business as and when you want to have that finance. So that's a little introduction to the alternative finance solutions that are in the marketplace, as opposed to your traditional type of lending that we all would normally think about. From our perspective at FIFO, what we try and do with all our clients, we have over 3,000 clients using a range of these products, maybe one or more of them. The aim really is about helping you understand getting to understand your business a bit with you, and understanding which is the best product fit for you to actually deliver on what you actually need to be done. I'd be very happy to take any questions.
Don't the banks offer this kind of finance, or do they offer similar facilities?
Good question. And look, the reality of it is banks are institutions, and they have set ways and processes of working. Trying to introduce a product like this within a bank, they do provide certain versions of the products, but typically it's difficult for a bank to provide. So, like, as an example, cash flow finance solution, a bank will allow you to finance, or one or two of the banks will allow you to finance every single invoice you raise to your customers. The problem with that is not all of your customers are on the terms where you need to use their cash flow solution. And ultimately, as a client, you should be able to pick and choose which invoices you might need to get finance on. So in that scenario, the bank product is more restrictive than what's actually being provided by an alternative.
If we've already got an overdraft, why would we choose FIFO's facilities, for example, over an overdraft?
Yeah, that's a great question as well. An overdraft, I think everybody in business would love to have an overdraft. It's that ability to just dip in and out of funds as you need to. But what you tend to find, particularly more nowadays, overdrafts simply don't cut it for businesses. You get a certain size overdraft, yes, but you want to start growing your business. Let's say, for instance, you have a large order come in, and that order is going to consume your working capital to fulfill. Your overdraft's not going to cut it if you're already using your overdraft. But with these alternative products, you can actually use the product for a project-specific requirement. So the other side is, if you're actually growing your business and you exponentially could bring on more clients, you can't necessarily buy the stock to fulfill those clients. Again, an overdraft, the bank isn't going to grow your overdraft at the rate you're growing your business. And typically the clients we will see will come to us with some form of bank funding, but effectively the bank have said it's enough. You can't get any more leverage off your house, Sanjay. So the challenge then is, the business owner, where do you turn when you're already leveraged? I mean, we don't think a business owner should leverage themselves up anyway. They should look at more smarter ways of financing. But yeah, typically an overdraft will go so far. But after that, it's all about, okay, what do I do next?
Okay, thank you, Wayne. I've got a couple of more questions. So, from the payables and the purchase finance you talked about, what sort of facility limits would businesses receive?
Okay, that's actually down to the business size itself. So what we tend to do is we would look at a business, and let's say we've got a business turning over, I don't know, say 500,000. It's going to need a different size facility, obviously, than a business turning over 100 million. We can service both. But the bottom line is we would look at that business, we'd say, okay, what do they need right now? We'd work with the owners to actually establish what is the right facility today. But equally, I think it's important to understand that $500,000 business might be a $2 million business within 12 months, and they're going to need to see that facility grow. So whilst we might put in the facility relative to the turnover today, we're also going to be working with that business to grow that facility to support that growth that they're expecting as well. But what we do, Sanjay, we have some very simple questions we'd ask a business owner to establish what they're looking for. From there, that's our start. We typically will issue an indicative offer based around those questions with a view to actually reviewing it as well. So they get what they need now, and they've also got a solution for the future.
Can we combine and use our facilities together?
That's, I suppose you could say, almost what we would call the Holy Grail of these products. If you think of Coles and Woolies, when we go and do our shopping tonight, we're going to pay for our lettuces before they have to pay the suppliers. They have what's called negative net operating working capital. That means they don't need the working capital that a business that typically needs to operate because they're getting paid before they pay the supplier. Our products work together, and from paying a supplier to getting paid by a customer, you can use our products, and we can show clients how to smartly use those products so they effectively overlap, so they can also, like what Coles and Woolies, get paid before they have to pay us for having paid the supplier, reducing the risk or the need for working capital in the business and being able to fuel growth.